Malls are dying, right? Like major luxury brands are filing for bankruptcy. They're closing their doors, cutting thousands of jobs.
Yeah, it's a pretty bleak picture on the surface.
Exactly. Yet right in the middle of this supposed retail apocalypse, you have billions of dollars of institutional capital from the world's largest investment firms.
Yeah.
And they're suddenly obsessing over something incredibly boring.
Right. Your local neighborhood strip mall.
Yes. Why is Wall Street suddenly treating the corner grocery center like it's the hottest asset on the planet? Welcome to this special deep dive.
It's a great question, and there's a lot to unpack.
There really is. Today we're going to make sense of the seismic forces that hit the commercial real estate world in late March 2026. This deep dive is brought to you by Eureka Business Group, the premier commercial real estate broker in the Dallas-Fort Worth market, specializing in retail.
Which is definitely a place to be right now.
Oh, absolutely. Our mission today is to cut through the noise of some very intense national economic headwinds. We're going to uncover exactly why retail real estate is undergoing this massive bifurcation, basically splitting into two completely different realities.
Right, the winners and the losers.
Exactly. And we'll look at why the Dallas-Fort Worth retail market, specifically, is currently operating in a league entirely of its own. We've got a really fascinating stack of late March 2026 commercial real estate data to get through.
Yeah, ranging from, global Federal Reserve decisions all the way down to highly localized Texas groundbreakings.
Right, because if you just look at the surface level headlines, the commercial real estate market looks terrifying.
It really does. It's a diagnostic landscape full of muddy waters out there right now. But when you look closely at the underlying data, the blurriness fades.
Yeah.
Yeah, a very distinct, almost mathematically precise picture starts to emerge.
Okay, let's unpack this. We have to start with the national macro environment, because to understand the local wins, we have to understand the national pain, right?
Exactly. You can't have one without the other.
So the Federal Reserve's Open Market Committee just voted 11-1 to hold the federal funds rate at 3.50 to 3.75%.
Which was a pretty loud signal to the market.
Yeah, that decision effectively killed any lingering hopes the market had for meaningful rate relief in early 2026. As a direct result, we saw the 10-year Treasury yield surge above 4.2%.
Right, which is a massive jump.
And this is all happening right as the industry crashes into a massive looming threat. The Mortgage Bankers Association pegs the total commercial real estate maturity wall at $875 billion for 2026.
That's a staggering number, $875 billion.
It is. And before we go any further, for anyone listening to us who, doesn't stare at Bloomberg terminals all day, I want to try to visualize this.
Go for it.
I look at this $875 billion maturity wall like a game of high-stakes musical chairs where the music is rapidly slowing down.
That's a good way to put it.
Right. With borrowing costs staying elevated and 10-year Treasury yields surging above 4.2%, I have to ask, is this a systemic crisis for all of commercial real estate, or just a crisis for those holding the wrong assets?
If we connect this to the bigger picture, it is definitively a crisis of asset selection, not a systemic collapse.
Okay.
What the data tells us is that the era of extend and pretend is officially over.
Extend and pretend. I love that phrase.
Yeah, for a long time, lenders were willing to just roll over bad debt, hoping the market would magically improve. But they aren't doing that anymore.
Wow, so the music actually stopped for them.
Exactly. Especially for assets with fundamentally broken business models, we're seeing severe distress in the office sector, for example.
Right, the office sector has been getting hammered.
Oh, absolutely. CMBS loan delinquency for office spaces hit 11.4%. But here's the critical mechanism to understand, that stress is actually forcing capital to rotate out of private credit.
Rotate out, meaning the money isn't just evaporating.
Right. It doesn't just disappear. It gets pulled out of the losing sectors and rotated into more defensive, hard assets.
Okay, so to understand exactly where that capital is going to find safety, we have to look at how the retail sector is splitting into two entirely different realities.
The great retail bifurcation.
Yes, the great retail bifurcation. And, you really cannot talk about the current state of retail without acknowledging the massive leadership change that just occurred.
You're talking about David Simon.
I am. The longtime CEO of Simon Property Group just passed away at the age of 64.
Yeah, it's a huge loss for the industry. His legacy is nothing short of astounding.
Truly. I mean, he took a regional family real estate enterprise and transformed it into a 200 million square foot global powerhouse.
Delivering, what, over 4,500% cumulative shareholder returns since 1993?
Exactly, 4,500%. He was the ultimate champion of the physical enclosed mall. But right as we reflect on his incredible legacy, we are seeing the absolute collapse of obsolete retail models.
Right, the older formats that just can't keep up.
Yeah, like Saks Global. They just filed for bankruptcy under the weight of billions in debt, closing dozens of stores, cutting over 1,200 jobs. Zumiez is closing 25 stores as they exit lower-tier malls.
The traditional mall format is definitely bleeding out.
But, and here's my pushback to the whole retail is dying narrative, we are seeing legacy, luxury, and apparel close doors. But at the exact same time, Apollo is pouring $1 billion into Realty Income's net lease property.
Yeah, $1 billion.
And Nuveen just raised $330 million, specifically targeting U.S. strip malls. Why is institutional capital suddenly obsessed with neighborhood strip malls?
Well, it comes down to understanding the mechanics of what we call defensive retail.
Defensive retail. Okay, break that down for me.
You have to look at how inflation and especially tariff uncertainties impact different business models. The traditional enclosed mall relies heavily on discretionary spending.
Right, buying things you want but don't strictly need.
Exactly, high-end apparel, luxury goods. When inflation is sticky, consumers tighten their belts. They stop buying the extra pair of luxury shoes. Plus, an enclosed mall has massive overhead costs for the landlord. Heating and cooling, huge common areas, security, roof maintenance.
Right, the operational costs are huge.
Defensive retail operates on a completely different engine. Investors like Apollo and Nuveen are migrating toward necessity-based, grocery-anchored centers.
Because people always need groceries.
Yes. They offer stable, consistent cash flows. They are highly resilient to the tariff uncertainties and inflation pressures that are currently, spooking the broader market.
Okay, and we actually have CoStar data showing that service-oriented tenants like fitness centers, indoor golf, spas, now lease more than 50% of total retail square footage.
Which is a massive milestone.
It is, over 50%. So understanding that national capital flow is great, but let's pivot. Let's talk about how these massive institutional strategies are playing out on the ground for Eureka Business Group's clients in North Texas.
This is where the story gets really fun.
It really does, because the demographic engine here is staggering. The latest Census Bureau estimates show that Dallas-Fort Worth added 123,557 residents in a single year.
That is just an unbelievable number.
It breaks down to roughly 339 new residents every single day. DFW is the second largest gaining metro in the U.S.
So that's 339 people a day who immediately need to buy groceries, get a haircut, find a dentist.
Exactly. And this translates directly into the retail fundamentals. According to Weitzman, for the third consecutive year, the DFW retail market has hit a record overall occupancy rate of 95.3%.
A 95.3% occupancy rate is essentially full.
Right. And they absorbed 3.8 million square feet of new construction on top of that.
Wow.
Here's where it's really interesting. I look at the national commercial real estate market right now, like a stormy sea, right?
Yeah.
And DFW retail is this heavily fortified island.
That's a great visual.
So how exactly does this sheer volume of population growth act as a shield against the heavy macro headwinds we talked about earlier? Like, how does population growth neutralize a 6.38% mortgage rate?
Well, it's a direct cause and effect relationship between rapid population influx and immediate retail demand.
Okay.
Think about it from a developer's perspective. If you want to build a new neighborhood retail strip in DFW, you are facing that elevated mortgage rate.
Right, the math is harder.
To make the math work, you have to charge significantly higher rental rates to your tenants. In most parts of the country, a tenant looks at that high rent, realizes they won't have the sales volume to support it, and the deal dies.
Because there just aren't enough shoppers to justify the rent.
Exactly. But in DFW, those 339 people arriving daily create an instant, non-negotiable need for daily needs retail. Retailers know they will have the sheer volume of daily foot traffic required to hit their sales target.
So they can comfortably absorb the higher rent.
Yes. The sheer demand actively neutralizes the negative impacts of high borrowing costs for local retail landlords.
That is fascinating. So the demand essentially overrides the interest rate friction.
Pretty much, yeah.
Okay, so understanding the data is good, but seeing the actual dirt move is better. Let's dive into some specific local transactions that highlight Eureka Business Group's core focus.
Let's do it.
We are seeing two major contrasting developments happening right now. First, the grocery-anchored boom. H-E-B just acquired 25 acres for a new store in Roy City, on the fast-growing eastern fringe of DFW.
Massive land grab for a massive grocer.
Right. And then contrast that with the urban luxury boom. Trammell Crow and its partners just broke ground on Knox and McKinney in Dallas.
That's a huge project.
It is the massive mixed-use project featuring 280,000 square feet of office space and, crucially, 20,000 square feet of ground floor luxury retail.
So you have the suburban fringe expanding and the urban core densifying at the same time.
Exactly. But I do want to push back a little bit here because even in a boom, the market is ruthless.
Oh, without a doubt.
We're seeing that Albertsons is closing 2 underperforming North Texas stores. So my question to you is, if DFW is at a record 95.3% occupancy, why are we still seeing well-known grocers like Albertsons close locations? Doesn't that signal a crack in the armor?
This raises an important question, actually. It's about how healthy markets function.
Okay.
In a market that is 95% occupied, closures aren't a sign of weakness. They are a sign of natural evolution.
How so?
Because the market is hyper-competitive, underperforming stores get culled. They just can't justify the real estate value anymore.
So they get pushed out.
Right. And because space is so tight, that large vacancy doesn't stay empty. It opens up highly coveted space for more relevant, higher-paying tenants.
So a closing grocery store is actually an opportunity.
Exactly. It's a prime repositioning opportunity. And this perfectly illustrates why having localized expert guidance from a broker like Eureka Business Group is so critical.
Because they know the difference between a dying location and a gold mine waiting to be repurposed.
Exactly. You need boots on the ground to navigate that difference.
So what does this all mean? Let's summarize this journey for you, the listener.
Let's tie it all together.
While the national commercial real estate market wrestles with interest rates and this massive maturity wall we talked about, capital is fleeing to the safety of necessity-based retail.
And nowhere is that safety more apparent or more profitable than in DFW.
Right. The rapidly expanding, 95% occupied Dallas-Fort Worth market is a fortress. But navigating this bifurcated market requires real expertise.
It's not a market for amateurs, that's for sure.
Definitely not. Which positions Eureka Business Group as the ultimate partner for identifying and capitalizing on DFW retail opportunities.
Absolutely. And, as we wrap up, I want to leave you with a final thought to ponder.
Oh, I like where this is going. Lay it on us.
Well, we noted earlier that 50% of retail is now service-oriented, right?
Right. The fitness centers, the spas.
Yeah. So as the definition of retail shifts permanently away from buying things to experiencing things, from standard apparel to sprawling wellness clubs, indoor golf, and massive medical spas, how will the physical blueprint of our neighborhoods completely transform over the next decade?
Wow, that's a really good point. The actual buildings have to change.
Exactly. When a shopping center becomes an experience center, the fundamental DNA of real estate changes. We'll leave you to think about what that means for the future of your community.